All right, let's talk about Lululemon. For years, this company has been an absolute rocket ship of growth, just unstoppable. But after their latest earnings call, well, they hit a wall, hard. And the market's reaction was, to put it mildly, pretty brutal.
Yeah, the second that call was over, the stock just nosedived, a 14% drop in after-hours trading. Now, that's not just a little dip. That's a massive signal from investors that they were deeply, deeply disappointed. Billions in value, just gone in a matter of minutes. So what on earth caused this kind of panic?
And this is where it gets really interesting, because it's a bit of a puzzle. See, on the surface, Lululemon's numbers didn't actually look that bad. Some were even pretty good. So how does a company beat earnings expectations and still get absolutely hammered by the market? Let's unpack that contradiction.
So here's that split decision I was talking about. You look at their earnings per share, or EPS, it came in at $3.10. That's a solid beat over the $2.86 Wall Street was expecting. But then you look at revenue. They brought in $2.53 billion, just squeaking under the $2.54 billion people were looking for. So a win on profit, but a miss, a tiny miss, but a miss nonetheless on sales.
And you know what? That's what it all came down to. Wall Street completely ignored the good news on earnings. Investors were laser-focused on just two things, that tiny little revenue miss, and, this is the big one, a huge cut to what they think they're going to make in the future. That pessimism, that fear about what's coming next, is what absolutely sank the stock.
So the first big reason for all that pessimism is a really serious and kind of unexpected slowdown right here in the Americas. And you have to remember, this isn't just any market for them. This is their home turf. It's their biggest source of revenue. So when the U.S. business stumbles, believe me, the whole company feels it.
And in a moment of pretty shocking honesty, the CEO, Calvin McDonald, just came right out and said it. He admitted the brand's product lineup has gotten stale. He said their core stuff, the lounge and casual wear, it's just not exciting people anymore. In other words, product fatigue has officially set in.
And boy, do the numbers tell that story. It is a stark divide. Comparable sales in the Americas were down a painful 4%. But at the same time, their international business is absolutely on fire, growing at a huge 15%. It's like a tale of two completely different companies, and the struggling U.S. side is dragging everything else down with it.
Okay, so as if having your products go stale wasn't bad enough, Lululemon is also getting slammed by this massive external force. Just as they're trying to figure out how to get Americans excited again, a huge policy change has created a brand new financial headache.
And that headache has a very specific price tag, $240 million. That is how much the company thinks these changes to U.S. tariff policy are going to slash from their gross profit this year alone. It's a massive, direct hit right to the bottom line, and it's piling on top of all their other problems.
So what exactly is going on here? Well, it all comes down to the removal of this thing called the de minimis exemption. Basically, this rule used to let Lululemon ship online orders under $800 from Canada to U.S. customers without paying any import duties. And this was a huge part of their strategy. We're talking it covered 2/3 of their U.S. e-commerce orders. Well, now that loophole is slammed shut and the costs are absolutely immense.
So you've got product fatigue at home and a massive new tariff bill to pay. The situation looks pretty grim, right? But management didn't just stand there and list the problems. They came prepared with a clear plan to fight back.
Their playbook basically has three main parts. First, they're going to aggressively refresh their product mix to tackle that predictability problem head-on. Second, they're speeding up their whole process to get those new products onto shelves way faster. And third, they're leaning into tech, even appointing their first-ever Chief AI and Technology Officer to really drive speed and innovation.
And look, they're putting real numbers behind that plan. They want to take the share of brand new styles from just 23% of their stuff today to a much healthier 35% by next spring. It's a direct assault on that stale product issue, and they're going to do it by injecting a whole lot of newness.
So, what does this all mean for the stock? We've seen the problems, we've seen the playbook they're running to fix things. Now let's put it all together and make a final call as we look ahead to their next earnings report.
Here's our outlook. Look, management has lowered the bar a lot, so we do expect them to hit their new lower Q3 guidance. But honestly, that's not enough to get excited about. We think the stock is going to be range-bound, just kind of trading sideways, until there's real concrete proof that the U.S. business is turning around. Until then, our rating is market perform. The story sounds good, but we need to see it in the numbers.
This is not financial advice.